Okay. I'm going to talk about SPY and our finance bear put spread, if you like, for a moment. So you can see just in the pre-market, SPY is down another 0.4%. So the market's kind of anticipating tomorrow there's the Fed's preferred inflation gauge, which is personal consumption data. That's out tomorrow. And it seems the market is doing a bit of a sell-off. But if you look here, I've put in Bollinger Bands on the chart. So we're just looking at SPY for now. And you can see it's been rolling in the upper channel for quite a period of time. It's been touching the outer extremity of the Bollinger Band and pulling back. And it's been doing that all the way up. So, this is why I'm saying that I'm not giving up on this trade, because if this finance bear put spread actually pulls back to the center line here in the Bollinger Band. So just to explain, first of all, what is a Bollinger Band? A Bollinger Band here is a 20 period moving average. So this is a daily chart. So that's a 20-day moving average, simple moving average. And then your outer bands are 2 standard deviations away from the moving average. And the idea of it is that more often than not, assets revert to the mean over a period of time. So in other words, when it gets to either extremity, it tends to migrate back to the middle ground at some point in time. Okay. Now, it's not an exact science. It's just another technical indicator. All right. But you can see here, just looking over the last number of months, SPY has been in the upper channel. So it's usually literally used as 20-day moving average as support, gone to the upper band, pull back a bit, gone to the upper band, pull back a bit, gone to the upper band. And you can see it's been on the upper band here for quite some time now throughout September. And this is the first time we've really seen it starting to come back a bit. And in pre-market, as I said, the pre-market low is actually taking out the low of yesterday. So this little downtrend, no guarantees, of course, is still intact. So that's why this finance bear put spread, I'm sticking with it. So I put out a note the other day saying that, look, we'll give it till Thursday, see how it goes. And surely enough, we've got a bit of a turnaround. So it's gone profitable now. That's going to be even more profitable today. But I just want to spend a bit of time on this because there's great learning in it for you, and why I think it was a brilliant trade, not because I came up with it or anything like that. It's more because just the outs that you have. So if you think about what this trade was, we basically had a punt that between now and October the 3rd, SPY is going to pull back. Now, when we place this trade, trying to guess within a 2-week period whether something's going to pull back or not is next to impossible. But we use all the indicators we can and we hope for the best, right? But what we did was we applied a bit of risk management to it as well. We went along and we sold this later 620 put, which reduced our cost to $90 a contract. So our risk was reduced and slashed. Now, if you remember the other day when I posted, SPY was up here. And I was saying to you, look, guys, if by Thursday this doesn't pull back, we're just going to close out the bear put spread. Now, if we'd have closed out the bear put spread, this was Tuesday here, okay? Or sorry, this was Monday. If we'd have closed out the bear put spread there, we would have actually taken in about $150 a contract in income. Remember, we only forked out 100, so we'd be up $50 a contract as long as SPY traded above 620 on October the 17th. So just going back to our positions here in Interactive Brokers, this is the bear put spread part of it. We own the 660 put, we've sold the 650 put, right? And then this was kind of put on to generate a bit of income to reduce the risk even further again, to reduce the cost of our bear put spread. So now we're really in this bear put spread for anywhere between $90 and $100, depending on when you put the trade on, right? And now SPY, if you look at SPY, in the pre-market here, it's trading at below 659 now. So it's moving really well for us, okay? And that's why I'm saying I'm actually going to leave it on. I know the trade expires next Friday week. Sorry, the bear puts part expires. So what I'm going to do is, and I'm hoping this is what happens, that this trends back to this moving average here, this 20-day moving average in the Bollinger Band. And at that point, I intend to get out. Right now, that's at about 654. But let's say a couple of days pass, that could be up at 655 by then, right? So we'll have to just wait and see where that's at. And that would probably be my cue to get out. Because if you look down here at RSI as well, RSI in the latest pullbacks, they kind of got to 50 and really haven't gone below 50. So if you look here, it's 50 here, just above 50 there, 50 there. So let's say we do get another couple of days of pullback. This RSI might be down around here again. So whilst I was hoping for a big oversold one here to come right down to the bottom, and it could still happen, because we've only got a week left to run on this trade, I'm not going to wait around for that to happen. So when we get down to 655-ish, I would plan to exit this trade. Now, what will our profit be on this trade at that moment in time? Well, it won't be our final profit. We'll probably be up about $3 or $4 on the bear put spread, roughly that. Because look what happens. The value of our long put here will go up. It will be well over 5, probably closer to 6 with the bit of time value in it. But the value of our short put here at 650, which we're short on, will also come up as well. It just won't come up as much. And that's why our profit will start to widen a bit. So if you think about it, if we close this out for a value, let's say, of 3 or 4, well, we only invested $90 per contract. And if we're selling it out at $400 per contract, that's a return on investment of over 300%. So that will be the plan. Then what we'll be left with is this short 620 put. So that's still a risk in the trade. If SPY does fall, then keep falling all the way down. You want to be comfortable here taking SPY on October the 17th at 620. If you're not comfortable with that, what we will do then is just roll out and down. So we'll roll out October into November. Okay. So the plan here with this trade, and it's been a good decision just to give it as much time as possible, is probably when SPY hits 655, we might look to exit the trade. And whatever profit is on the table at that stage, we will take it off the table. Okay. So I just wanted to highlight the brilliance of this trade. The fact that it was going against us the other day. SPY rallied since we put on that trade. Remember, we wanted it to come down. It went up. And we still could have exited, made about $50 a contract profit. Okay. As it stands now, if we're right, we might turn that profit from 50 into about $300 or $400. We'll just have to wait and see where the chips lay at the time. Okay. So that's that finance bear put spread. I just really wanted to emphasize knowing how to use options to your advantage, and then learning how to manage the risk is really, really important. So if you look at what we were going to do the other day, we were just going to close out the bear put spread and take that $150 off the table. We forked out 100 for the trade, so we'd be plus 50. As long as SPY then stayed above 620, we'd make $50 a contract profit. Roll forward the clock 2 days. This trade is starting to move in our favor. Happy days. We might make $300 or $400 a contract profit here. We'll just wait and see. I'm not going to look for the full Monty on this, because if you just look at the chart here, it's just rebounded off the moving averages every time, and the same with RSI. And whilst the trend can always change, we just don't have enough time to allow that to happen, if you get what I mean. So that's SPY in a nutshell. Have you any questions on that? Is there anybody that doesn't understand what they need to do? Okay.
I'm happy with the explanation, yes.
Okay, so that's great. So what will happen then, folks, is I just want to fast forward the clock. Let's imagine tomorrow SPY is down at 655. Okay, what do you do? Well, you're going to come into your positions here and you're going to close both of these legs here. So I'd suggest you come in and close your 660 first. So you don't close the 620, you leave that open. So we'll come in here and you're going to see, we'll literally click on this position here. And depending on the number of contracts, you're just literally going to sell the 620, the 660 October the 3rd put. And at the same time, then you're going to go and buy back the 650 short put there. So that's literally what you're going to do on Friday. Okay, if it goes to 655 or 654. So you're closing these two legs. It might give you the three dots on the right hand side here. If that's the case, all you do is go into the exact same contract here, and this case you're going to sell whatever. Let's say you two contracts to 660, and if you two contracts to the 650 short, you would buy them back to close out, and then all we'd be left with then is the 620 put. Okay, so that will be the chain of events, and roughly 655 is probably my trigger for this trade now at this stage to exit, unless we get some sort of a whammy down day, which basically changes the game, where it's very clear this trend has really changed. But if that doesn't happen, in the absence of that, we'll just take the $200 or $300 profit off, whatever that number is. Okay. All righty. Before I get into Amazon, just want to talk about the decision on look at the 10-year bond. I said my fear was that this is going to start rallying again, the bond yields. And again, tomorrow is going to be a big day for bond yields, because if that inflation data is worse than expected, you're going to see bond yields go up again. And that's why I was saying to people, probably exit out of TLT. You can see that's down again in pre-market. So, everybody's done well on that. So my kind of trigger on TLT is when bond yields get to maybe above 4.2%, close to maybe 4.3%, in between that range, I might look at doing TLT again. Okay, so for now it's parked. Okay, moving on to natural gas. Again, a good decision not to chase natural gas up. You can see it's pulled back a bit. I really just want to see it down at this 250 level, guys, and then we'll be in. But that is a high risk trade, high returns. Again, I just want to highlight there, this is in a matter of what, 2 weeks here, that was up 20%. Now look at in a matter of another 2 weeks, look how far it's down 11%. So that one isn't for the faint-hearted. So if you go in there with your eyes wide open. And that's why I'm really looking for the 250 level before I get involved there. So as I mentioned in my text earlier on, I'm looking at a setup trade here on Amazon. And if you look at Amazon on its Bollinger Bands here, now this is an exact science. You can see it's at the outer extremity here. And normally when that happens, you get some sort of a migration back to the mean here. So the mean in this case is your 20-day moving average, okay? So if I looked at where Amazon finished yesterday right to the mean, you could look at this as a short-term trade if you wanted. It's 4.4% just to get to the middle ground here. If it gets back up to the upper extremity or our target price for the stock, actually it's about 15 to 20% upside, okay? But the trade I'm looking at is another combination option trade. And I want to just kind of go through that with you. Because again, I think this gives you so many outs that, it's not that it's a no-brainer, but it's as close to it as possible. So you can see Amazon is clearly in an uptrend, even with, this recent pullback here. So trade number one, you could jump in, buy it now, and try and get out 5% higher. That's roughly the short-term trade, okay? If you wanted to apply a more risk management approach, we could use a financed bull call spread. So let me go through that with you. So what we would do is, and in order to give that time to work out and take advantage of the Santa Claus rally, we would go out to the December expiry on Amazon. And I'm going to show you what I'm talking about here, okay? So what we could do is go out to December and basically buy a bull call spread, and Murphy's Law, it's not giving me the thing for whatever reason. I don't know why. Should pop up. Okay, I'm going to have to switch to Yahoo Finance here very quickly. We'll get the options in here. So give me 1 second. So we're going into the options in Amazon, and we're going to go to the first part, which is we're going out to the December expiry, December the 19th, and we're looking at calls. So we're going to do a bull call spread. Okay. Now, if you go into equity scan here, we bring you on Amazon. Our 12-month target price on Amazon is circa 280, I think. I'll just double check that. It's 262, and the analysts are at 264. So the stock is currently at 220. So that's a 20% upside, right? But let's say we're not going to wait for that. Let's say by Christmas, we think it's going to get to 240, for example. So what we're going to do, we're going to go and look at the call options at the 230, 240 combination. So you can see here, to buy the 230 call, it's costing you $11 a contract, quite a lot. That's why we do the second part of the trade, which is sell a call option. So this is where your bull call spread comes in. So we're forking out 11. We're taking in 750. So the cost of that trade now is 350. Okay. So we're risking 350 to make 650. But if you've got an account that's big enough, we can reduce that cost again. And we can come in here and we'll look at the put options instead. So we'll just look at the puts for the same expiry. And let's say you were comfortable owning Amazon at 200. Look what the price of the put option is. We actually can turn this trade into a credit. So we're getting paid $5.59 there. Okay. For basically $5.59, we know we were forking out $350. So actually we're taking in $200 a contract. And this is what that trade would ultimately mean. Okay. It would mean that with Amazon, first of all, we'd want to be okay with taking Amazon down here at 200. You've seen our target price is 260. It doesn't mean it's going to go to 260. But if it did, that's a substantial jump there. That's a 30% target price jump. So you shouldn't have a problem owning Amazon at 200, in my opinion, right? But then again, each company, there's risks to it, right? The first part of the trade is the bull call spread. If Amazon finishes in December above 240, you're going to make $10 a trade plus the 250 we've taken in, which is $1,250. So it's $1,250 profit per contract. If Amazon goes up 5% from where it is now, 5 to 10% from where it is now, sorry, 10%. So that's what we're banking on with this particular trade with Amazon. Let's say Amazon doesn't go up and it stays roughly where it is now. We're still going to make the credit we took in. Okay. So the risk with this trade is if Amazon literally does a dive and starts falling down here. Okay. So that's the real risk with this trade if we get a serious sell-off in Amazon. And that's where the second part of the trade is risky. It's where you're selling a short put on a stock. Remember, one contract is exposing you to literally $20,000 worth of Amazon. Okay, so you have to have a sizable account to do this. If you don't have a sizable account, what you could do is go to the next phase, which is turn this into a bull put spread. So rather than just having a short put here at 200, you could actually buy the 190 underneath it, and that will reduce your risk on it. So let me show you that. If we bought the 190, that's going to cost 350. So this will actually turn your trade into cost neutral. So look at this here. We're taking in 559. This, I'm talking about the bull put spread, or sorry, my apologies. The bull put spread part of it. We're taking in 559. We're forking out 350 for the insurance down here, if you want it. So that is a net credit of 200. The first part of the trade, let me go back into the call options. So we go back into the December calls here. We're forking out 11. We're paying out 9. That's 2. So now the trade is costing you nothing to put on. So your risk now, if you use the bull put spread side of it, the risk is $1,000. That's all you're risking per contract. That's all you can lose by buying the added protection down here. So if your account isn't big enough, or you're not sure on Amazon, you know what, it's just too risky for you, you can reduce your risk by buying a bull put spread down here. Okay, so that's the trade I'm lining up. I'm not ready to place it yet myself because the market is ticking down. I think everything will tick down with it. But one of the trades I intend to pull the trigger on is this, and we'll probably be able to get it even cheaper, as it keeps ticking down. So that's one I'm looking at Amazon. Any questions, guys? You want to jump in on that? Or do you fully understand it?
If it drops, you won't change your entry point.
No, if it drops, I'm going happy days. I'm getting in here cheaper because my bull call spread, Michael, will be cheaper.
Yeah.
And also, I'm going to get more income in for my bull put spread. So it'll actually probably turn into a credit. So just note the time. Normally we go out a month on these trades. In this situation, we're actually going out to December. And the idea is to benefit from the Santa Claus rally and to allow things happen. So, you know, for people who are conservative, probably using the bull put spread is the best way to go. At least you know all you can lose before you put on the trade, which is $1,000 a contract. So you're risking 1,000 here with the bull put spread to make 1,000. So it's it's basically 100% return on investment if we're right. If, for example, Amazon falls another 10% from here, you're not going to lose anything. You know, that's the beauty of the trade. We just need it to go up or else we don't make anything. So it depends which way you do it. So that's just a trade I wanted to start highlighting to you, because we're going to do more and more on that with individual stocks that start to come into our universe. Okay. So it's worth doing your homework on that. So I'm going to show you. I can't even put it on in here to show you actually, which is not good. It's something to do with the pre-market, I know, but normally you can get away with it. When the time comes anyway, I'll do a video on it, folks. So I don't know what's going on with Interactive Brokers here. It just won't allow me to do it. But you get the numbers. Yeah.
Even if I can interrupt you there, sorry. Just out of curiosity, how did you find this? I mean, and you just touched on the end there. You're going to be looking at others that come into your sphere. How did you go and find that? What prompted you to go look for that? What was the signal? You didn't just pick Amazon out of thin air. There must have been a reason for it. What were you looking for? So I can start my own homework.
Superb question. So I use my trading view here. So I've got screeners in here, Stephen, right? So I've got a screener in here that's set up here for equity scan, what I call a trend exhaustion, right? So just let me go down here for a second. So sorry. Trend exhaustion here, right? So stocks, I had different filters in here and I've literally kind of changed it again, right? So I didn't have my RSI here. So I wanted stocks that were on the lower Bollinger Band, where the stock price was below the lower Bollinger Band. So that was my first screen. And I screened just equity scan stocks. So stocks that are within my universe. So stuff that we've covered in here, right? So anything that popped up, and Amazon was one of them, but I want to show you why it's not in this screen here now at the moment, right? It's because I've asked for RSI to be below a certain level. And it didn't meet that criteria at the close yesterday. That's why it hasn't shown up in this particular screen at the moment. Okay, so if you look at here, what are my parameters? I'll just show you here very quickly. So I'm looking for the price to be below the lower Bollinger Band. I'm looking for the analyst target price to be greater than 15% from where the share price is now, and I'm looking for RSI to be below 40. Okay.
Is that a formula that you're aware of? Is that's something that you have up your sleeve? Okay, listen, 1, 2, 3, give me this. Or because this is still new to me. In fact, one of the things I wanted to talk about on our next one-on-one are these screeners again. Yeah. Oddly enough, I know we spoke about it several months ago. So I'm glad you're mentioning it. So tell me about, I mean, this Bollinger range, this target price, this the RSI. I mean, clearly these are things that are go-tos for you. These are something that you're clearly familiar with. Am I right in saying that? Are these something that is this something you use frequently? Is this, is this part of your technique?
Like I told you a while back there, I'm not a fan of stocks because the market is melting up, but we're getting into October now, and I know the market continues. October can be a bit ropey as well, by the way, right? But I'm getting ready. Like, I have a diverse range of clients. Some people are just not happy just doing SPY. I think SPY is the no-brainer trade. But people who are looking for option strategies, for example, exciting option strategies with the risk mitigated. So I'm looking for opportunities in equities other than, SPY and everything like that, right? So these screeners, Stephen, the Bollinger Band, and remember, these indicators are not the holy grail. You got to understand that straight away. But understand what the Bollinger Band is. First of all, this center line here, see this little blue line? That's a 20-day simple moving average. So all that is, Stephen, I can change that, by the way, to 30 or 40, but 20 days is the standard. And all that does is get the last 20 days closing prices and averages it out and keep smoothing it as it's going along here. Okay?
Gotcha.
The upper band here is 2 standard deviations away from the center line. And the lower band is 2 standard deviations away from the center line.
Gotcha.
The idea is there's a theory in mathematics called reversion to the mean.
Gotcha.
That assets and things in general usually revert to their mean over a period of time. Now, the mean is your 20-day moving average. So the mean is moving all the time, though. So it can be ticking down. So just because your outer Bollinger Bands are getting tested in a big way, this can move down and keep ticking down. It's not the holy grail. So that's where RSI comes in. So now I look for something that looks like deeply oversold. So for example, back here, I much prefer. Here under 40, it's still, can continue on down. So all this is done now is come onto my radar and go, I'm really interested in this. So the next step then is equity scan. It's okay, what's equity scan telling me? Oh, 19% upside. And I look very quickly here at, our target price is 262. The analysts are at 264. So we're not too far apart either, right? Then you're into your news flow. You're into what's going on with the stock. Why is it pulling back? And if you look at it in the greater context of things, since last April, it's not a huge pullback at all. It's just quite normal. So now I'm going, I actually like this opportunity. So now I'm going, right, how do I trade this, or how do I want to trade this? So the first way is just a simple buy the stock, trade it up to the upper or the middle band if you want, as a kind of a very short-term trade. Take your 4 or 5% and walk away. That's one way.
Okay.
The lower risk way is to do what I suggested, which is to do something like a bull put spread here, which finances your bull call spread going out to December. And that gives you a higher return on investment with a lower amount of risk, basically. And if you think about the trade I'm talking about there, your break even is right here. So in other words, we're saying here, actually, we're going to put on a trade that's going to allow Amazon fall 9% from here. So Amazon could fall another 9% before we'd be in trouble with that trade. And whereas if you buy the stock today and it falls 9%, guess what you're doing?
Yeah, tough luck.
Do you know what I'm saying? So you look at it, the risk is lower with this trade. So I'm just trying to expand their knowledge. But as regards finding them, I'm making it look very simple here, Stephen. I'm literally doing this. I'm constantly reevaluating all this stuff. And then I go through every single company and I go, not interested, not interested. It could be a sector they're in, or equity scan could be saying to me, there's not fundamental upside here, whatever. So, just because there's 10 stocks there, you don't go, right, I'm trading those 10 stocks. So you start then doing your due diligence on each one of them. So that's just one of them. That's just one of the things. Another scan, which you can use equity scan in very, very quickly, I keep saying to people, is literally just go into your 14-day RSI here, use it as a filter. Okay, and let's say you go, right, show me all stocks that are below 35 in RSI. So that's oversold, yeah? And it's see, you can 57 stocks up here. Then I'm going, okay, now filter, I want something that has at least 15% upside from here. So you filter again. Now we're down to 48 stocks. Now you start going through each one of them, one by one, and stuff might appeal to you and then others might not. You start, for example, if I go into Amazon, what I'm doing here with a lot of stocks that I ruled out as well, I'm looking at forecasted earnings and sales. And I want to see this trend. I wish I had a little arrow here. this trend is going up. Forecasted earnings are going up. Forecasted sales are going up. You want to see that as a minimum. There was a lot of companies today that showed up in the scan, right? But their actually future earnings and revenue targets were down, lower. So I immediately cut off, not interested. Market doesn't get excited about that stuff, okay? So then I'll come into my statistics here, and I'm just showing you what I do on a really quick basis. I immediately go looking at operating margins, and I go, are their margins holding up? And you can see with Amazon, it's holding up fine here. It's been above 10, 11 for the last number of years, and it doesn't seem to be changing. Then I go down to kind of debt to equity, and I say, well, look, has this company gone nuts, you know, buying up stuff and is now paying a lot of debt back? And I'm not looking at anything there that scares me either. And finally, then I'm looking at my price to earnings and price to sales ratios. I'm checking in here again. Am I too ambitious with my own formulas here? Remember, sorry, I have to clear the filters. So I'm looking at a 35. I've used a 35 and a 3.5 price to sales. And I'm coming in here and I'm going, oh, well, yeah, 33, 35 here. It's not out of the question. 3.5 is normal on the price to sales side. So maybe I want to err on the side of caution. I'll bring this down to 33. You can see what happens our target price now. This is going to come down to 257. So, you know, this is what we're looking at here. You know, you're looking at your valuations, and that's kind of the deep research, and you start getting into the news flow and everything else that goes with it. So I know that's very long answer to answer your question.
It is. Funny enough, I remember, you know, was it progression toward the mean? I haven't heard that for 25 years, you know, not since my uni days. So, I mean, clearly I have some homework to do. But thank you very, very much. We'll have a chat next week ourselves, and maybe we can go through this little more detail from me if you don't mind.
Absolutely, not a problem, Stephen. So
fella.
Thanks for that, Stephen.
Yeah, no problem. So just on that, just to finish off, guys, right? Just now we're in this, right? I just want to show you Bollinger Bands can keep expanding down. Just because it's hit the outer extremity doesn't mean this downward trend is over. So we wait till that trend is over before we put the trade on. I hope that makes sense to you. Like, you know, there's a chance here this could come down to the 200-day moving average. So just because this happens, it's not like a trigger straight away. I'm buying here. Okay, it's on our watch list. I'm now trying to identify the lowest risk option trade I can find to support my bullish thesis on Amazon, but without having that massive risk that's out there. And at the moment, right now, it's the 200, 190 bull put spread to finance the 230, 240 bull call spread. If that doesn't work out, if this keeps falling down, we might shift that down to the 190, 180 bull put spread to finance the 220, 230. Do you understand where I'm going with it? So it's just now on my radar, and we're getting ready to pull the trigger on an option trade here. But the beautiful thing about this, guys, is, you know, when you're investing, you know there's risk. You can't, there's no such thing as a free lunch. But what you're doing here is saying, look, I'm giving this asset an opportunity to fall here, and I can still make money here, you know? So that's kind of the trades we're trying to put on. It was the same with our SPY trade. We gave ourselves a lot of outs with this financed bear put spread. Just because we forked out $90 or $100, I had no intention of losing $90 or $100 a contract. It sounds like nothing, but it actually, you know, it depends how many contracts you've got. If you have 20 contracts on, that's $2,000. We could have closed that out the other day and taken $3,000 back in. So my point is, that's the beautiful thing about options. It gives you choices. It gives you ways to construct trades that can benefit from your bullish thesis, but you can still reduce your risk just in case you're wrong, you know? So a lot of other stocks we're starting to pop up. I've loads of them here. Adobe now is getting interesting to me here, guys, again. So I just thought I'd mention that to you. Accenture. So some of these, and I'll talk about these again. I've been doing scans, right? And this is a new stock. You haven't heard of it yet. It's called Texas Roadhouse, right? And they're basically a steak joint, and they've got like Longhorn Steakhouse all over I think their product is better because I've tasted it. I've been over there, and unfortunately it added a few pounds onto the gut.
Yeah, I'm well familiar with it myself.
Yeah,
It's all too familiar.
I love the food in it, and it's a great atmosphere in the place. So all of these restaurant chains, right, are coming down for the obvious reasons. What's been going on with inflation and cost bases, etc., like that. That's why you're seeing these downward trends. But this has come right back to a support area, which I like. This is not an equity scan just yet. It will be shortly. Okay. So that's just another one I'm starting to tee up here. I want to see that we get some sort of a consolidation down here. If we skip up here, you can see Restaurant Brands International, think Burger King and others. This is the same. Look, it's trending sideways here. So for guys who like that sideways trending stuff, there's one straight off the bat. Now, remember, these have their challenges. Their margins are being pressured because the costs of ingredients have gone up, costs of labor have gone up. Don't forget it. So there's a reason why they're not performing well. So we've got to satisfy ourselves first that this is changing. Again, Adobe has been unloved there for quite some time. I think it's great value down here. Okay, so these are a mixture of stocks that I'm potentially looking to trade for a short period of time to benefit from the reversion to the mean, and others for longer term buy and hold, such as Adobe. Okay, look what's showed up. Coca-Cola. Hard to believe Coca-Cola is unloved at the minute, but it is. It's again another stock. If you think about what's going on as well in the US with their health secretary, big focus on obesity and everything else, and he's saying target the manufacturers of sugar and everything else. That's why the likes of Coca-Cola are under pressure. Okay, so I just said I'd mention a few of these. I'm not ready to say let's buy anything right now, to be quite honest with you. You know, I much rather construct the option trades we're talking about. So the final focus just for today is SPY. How are we going to manage this, guys? Remember, there's a possibility of making a 200 or 300% return on investment here in this trade in the next day or so. I will alert you when we decide to take it off. At this moment in time, 655 is my trigger to get out of it. I probably won't wait for it to go lower than that. We're not too far away. Look at it. It's at 658.44 in pre-market. Okay. So it's less than 0.5% down from where it is right now in pre-market. So this could happen by tomorrow. It may not happen. Okay. So I want to go through the options with you again. If this falls to 655, I'm taking off the bear put spread that expires on October the 3rd. If, on the other hand, it goes back up again, I'm still taking off the bear put spread, probably on Monday or Tuesday, and we'll probably take in our $90 or $100 and walk away break even on the trade. I have no intention of losing on this trade. So I just want to be clear. We will be taking action on this by Monday or Tuesday at the latest, probably potentially as early as tomorrow, depending on where the share price goes. But I just wanted to be really, really clear. And what you need to do then, hop into your Interactive Brokers account, take off the October 3rd, 660 and 650 put options, and leave open the October 17th, 620 put options, short puts. Now, if SPY did fall, guys, to 620, I'd be going happy days. I would actually take the assignment at those levels. I wouldn't hesitate this time around. So that's me. Everybody, it's a different story when you get down there. The nerves start jangling and everything else. So you might change your mind. If you change your mind, that's fine. You can roll out and down. I intend taking an assignment of it. Okay. Is that all right, guys? Any questions? No. Okay, listen, have a great day, folks. I'll leave it there for now. And sure, you know where I am if you have any questions at all. And we'll chat soon.
Thanks again, Stephen.
Thanks,
No,
Steve.
Right.
bye for now, guys.